Welcome back. This is Jacob Milliken with 9M Investments, and today I'm going to be talking about tax strategies for capital gains, making sure that whether it be from a business or from a real estate sale, there are different ways that we can possibly defer those taxes or even possibly eliminate those capital gain taxes altogether. So the first one I'm going to talk about is 1031 exchanges for real estate investments. As I said, this one fits with real estate, although there are some timeframes that you have to make sure that you fit in for these to work for you. So you have 45 days post-sale to pinpoint up to 3 replacement properties. The timelines, the acquisition of this new property must be finalized within 6 months or 180 days. So really lining these up with the sale of your property is very important to make sure that you hit those timings. And obviously you want to have somebody that's qualified to actually hold the sale of these proceeds. So there's lots of different companies out there, lots of different investment vehicles out there that can help provide this. But again, timing up that when you sell your property, make sure you have that new property well in advance and you kind of know what you want to go into is a very important part of 1031 exchanges. Delaware Statutory Trust, another way to defer those capital gains, really can convert those real estate assets into DTS investments, gives you a broader scope of not only the type of investments, but also possibly give you some liquidity, potentially get income off those types of investments. Again, want to make sure that you kind of line those up of what fits for your portfolio and what you're trying to accomplish, whether you need some income off of those capital gains or you're willing to roll those into the next investments without the kind of the day-to-day operational responsibility. And then lastly, investing in opportunity zones. These are huge. Now, again, with all these types of investments, there's some pluses and there's some advantages. With opportunity zones, kind of the disadvantage is you have to hold them longer periods. So either 5, 7, or even 10 years. But if you have the ability to hold those investments for longer, especially at the 10-year window, you can completely eliminate those capital gains. So if you're selling a business or selling some real estate, the ability to just eliminate those capital gains altogether or be able to lower those capital gains is very important. Now, again, this has to fit in with your overall portfolio and what you're trying to accomplish. If you need to use these investments or use this income, these are probably not the way to go. But if a tax elimination is part of it and you have the time frame that fits with it, a great way to do that through opportunity zones. So again, very 3 different ways that you can really kind of eliminate or defer those taxes into the future. Again, that's where all the planning pieces and your kind of overall portfolio and what you're trying to accomplish really have to make sure they match these different things. But again, these are 3 great strategies for help defer these or even possibly eliminate these. So I hope this was helpful. If you have any questions about your particular situation or how these might work with what you're trying to do, always feel free to reach out and be happy to help you figure these out. Again, this is Jacob Milliken over at 9M. I hope you have a great day.